We're so excited that we have Jordan in the house today, and he's going to give us some good insight. So, Jordan Levine is our Senior Vice President and our Chief Economist over at the California Association of REALTORs. And he is a California boy living over there on the Central Coast. And he's going to come up here and give us a report on what we have to look forward to. And he's so fun to listen to as well. So you guys are in for a treat. Jordan?
Thank you. Yeah, when the information's not as good, we jazz it up with some. No. Yeah, thank you for having me back. I'm excited. I brought a lot of local Bakersfield data. Ditch my gum. I'm channeling my friend Steve Marvin would yell at me for that. Yeah, brought a lot of local Bakersfield data. I'll make sure to send this through after. I should have sent it before, but I didn't get around to doing these slides till yesterday, but they are more fresh as a result. So you'll have these to use and talk to your clients and all of that. I've had about 20 cups of coffee this morning, so I'm going to talk really fast, and you'll probably be overwhelmed, but hopefully there'll be at least a handful of useful kind of scenario type stuff that you can use for that situation that you're in with an intransigent seller who we've got a lot of mismatch of expectations. Maybe I should leave it at that and keep myself employed. So you'll have all of this stuff. I thought I would start off by doing a little bit of a roadmap of where I hope to go, and then I'll probably be like off track of this plan in less than 5 minutes. But this is what I was intending to do, was to start with like a macroeconomic overview of just where we are, where we've been up to now, and kind of set the stage for why my forecast looks the way it does for 26 and beyond. The bottom line is that we're still growing. Like, there's a lot of volatility, a lot of negative headlines, there's a lot of uncertainty. We have not experienced a ton of growth this year, but we're also not experiencing really any contraction. So, most of the major macroeconomic indicators still at or near all-time high levels. It's all about concerns over the future, not about negative stuff that's kind of materialized thus far. Still has real impacts, right? When I'm scared, I don't buy stuff, I don't go out, I don't buy houses and all of that. But it's not because everybody's unemployed and losing money and all of these kind of negative outcomes have happened. That being said, I think the volatility is going to continue, meaning that slow growth and kind of this lackluster environment where we feel like things are terrible, even though they're not really getting much worse, because they're not getting better at a rapid pace, it leaves us all very disappointed. And I think that is kind of going to be the theme. Like, the underlying data will stay positive, but it's not going to be so positive that you can finally like breathe that sigh of relief, loosen belts, kick back, throw it in autopilot, all that kind of stuff. Housing market has been depressed now for 2 to 3 years running, and even with all of those major macro numbers through the roof, essentially, housing is still very depressed. So like, transaction numbers now are essentially where they were during the 2008 financial crisis, even worse, despite the fact that all those economic numbers are high. And I think, again, this is instructive because even if the economy doesn't deteriorate and like the stock market stays high and GDP continues to grow, that doesn't always translate into more transactions the way that it did in the past. Back in the day, we used to build forecast models for home sales, and you'd throw in some like key economic data, and you could usually do a pretty good job with minimal amount of forecasting skills. You throw in incomes, you throw in jobs, you throw in interest rates, right? Put it all together, and it spits out a transaction number that was usually moving in the same direction. Now we put in all-time highs for all this stuff. It does not kick out 200,000 home sales in that kind of environment. So like, sales are way lower than the economy would suggest that they should be. That also, I think, is instructive, because we can't just look at a 47,000 on the Dow or 5% GDP growth and think that means Bakersfield home sales shoot through the roof, because we're just such a bifurcated economy right now. I do think we'll see more inventory as the lock-in effect goes away. As rates come down, less people will be held hostage in these low rate loans that they've had up to this point, but I think, which means the market's less competitive for buyers, which is all a good thing. While they're hyper obsessed about how big the next Fed rate cut's going to be, they're forgetting that the market is like in this lull in competitiveness right now, which is what you should be taking advantage of, and then getting the lower rate when it goes down in the future. Instead, they're like drinking the Kool-Aid on this idea that their foreclosures are right around the corner, that rates are going to be 4% again soon, and like waiting means saving a bunch of money and all of that stuff. So you have all these gainfully employed, high-income renters out there thinking they're doing themselves a favor. That's also, I think, an opportunity for us, because I think it was Veronica was talking about how people just have no idea about down payment. I said that's very conclusive in our consumer research that we do. Like, do you want to own a home? 70% say yes. We say, how much down payment do you need to purchase a home? We surveyed 1,000 California I'm going off track already. I haven't even got through but we surveyed 1,000 California renters this year and said, do you want to own a home? Yeah. How much down payment? Like, it was over 20%. I think it was like 23%. Basically, like 1 out of 5 of these renters that we talked to thought you needed at least 50% down or higher, right? And these are all employed, high-income renters. So even in a place like Bakersfield, where the home price is a lot lower than the statewide median home price, right? If you think that it takes 50% down, and then you go on the Sierra website and you see Kern County median home price, $440,000, right? And then you log into Golden One and you see that there's not $210,000 in there, then you never like call anybody or start looking at homes or anything like that, right? So like, point being is that we can't rely on the economy, but point number 2 is that we don't have to, right? Like, you can create demand out of thin air by approaching all these high income, gainfully employed people and going, why are you paying somebody else's mortgage? Like, prices only ever go one way over the long term. 15 years ago, you could have bought a single family home in Bakersfield for like $100K. Now they're $400K. If you wait another 15 years, they're going to be $800K, right? So like, these are the types of things that don't wait for the Fed, is the moral of the story there. I'm going to share with you my kind of red flag things, and I'll tell you right up front that my forecast is positive. We have more GDP growth, kind of unimpressive amount, not a number to write home about, but ongoing growth nonetheless. We have sales going up about 5%. Again, not to a blockbuster number, but improving. Prices that will still go up a little bit too. But I want to put on your radar the things that could make my forecast incorrect. Anybody that comes and delivers a forecast, if they're not telling you up front that their forecast is wrong, then they're lying to you. Mine is wrong, and so I'm going to share with you the reasons why it could be wrong to the downside and why it could impress to the upside. And just these things that aren't what I'm forecasting, but they're those looming things that maybe we got to be aware of. One of them is that even if we don't have a big implosion macroeconomically, there are a lot of red flags in the stock market, in commercial real estate, with consumer spending, 3 very important parts of our whole entire economy that will, even though they're not directly related to housing, have spillover effects if they tank the stock market, right? If they cause a lot of unemployment, those things can come back and impact residential real estate, even though we're not out there directly transacting on a lot of offices and stuff like that in Kern County, right? The other thing is that even as we haven't lost a ton of jobs, it's clear that the labor market is weakened. We're in a government shutdown, so we're not getting any good data really on jobs. But the stuff that we have suggests that we haven't seen a huge deterioration in the labor market or a huge decline in the number of employed people. But what is clear is that hiring has like frozen to a halt. They're not adding new positions. They're not expanding. They're throwing more stuff at the computers, right? And that's why I put that as part of the structural issues as well. We both have housing structural issues and affordability stuff that we've been talking about for decades. We don't build enough, so home prices have gone up way more than incomes, and all of that is going to continue to keep the number of first-time buyers more depressed than it otherwise would be in a robust economy. But now we've got AI and all of this other stuff that's even further kind of eating into the regular person's ability to keep up with home prices, right? Because if I don't hire an assistant and I just up my subscription on ChatGPT and all that stuff, right, that eventually macroeconomically, if you aggregate that up across all these businesses, still affects us. And then, of course, our housing supply challenges are not going away. And I brought the local data for Kern County on residential construction. And it's both like encouraging in the sense that you all are doing better than most other parts of the state when it comes to being friendly to new residential development, and also depressing because even outperforming locally here as we do, it's not enough still, and home prices are $440,000. So this is kind of where we're at, and why even as I'm optimistic, it's not a take your foot off the gas, like throw it in cruise control. Great economy doesn't always mean great housing market because of these structural challenges, and why I think there will be a ceiling to how much this recovery, or how fast it will progress, I guess, is the better way to say it. Now, there's also a potential for the numbers to come in and blow the doors off my forecast on the upside, too, for a couple of reasons. One is that rates are coming down, and even though the decline has been, in my mind, relatively small and probably won't be huge next year, because we're so hyper obsessed with the Fed and interest rates, and because frankly prices are so high, even little changes in rates tend to have a pretty big, like I would say, an outsized effect on the housing market. You can already see that just over the last month and a half. Pendings in particular have really started to ramp up, suggesting that we'll have an unseasonably strong winter here. These are all people that should have bought 3 years ago, so I'm not congratulating them too much, but it is like at least noteworthy that when rates do come down, as they're poised to continue doing very slowly, demand responds to that, and that is a positive. The other kind of source of optimism is just that financial education piece. Get people more long-term focused, less short-term focused. Why do you buy a house in the first place? Because we've gone from 100,000 to 400,000 and beyond. You're already paying a mortgage. It's just your landlord's, right? All of these things, like it's a financial investment. You don't even have to use all of your own money. People always talk about other forms of investment compared to real estate, and they're like, look, if you bought gold, or if you would have bought a Bitcoin or something back in the day, it's like, yeah, but you can't live in your Bitcoin, right? So you got to buy like a lot of gold if you want to live there. So the other thing that I think is a real wild card for explosive growth is the capital gains thing. You have a lot of people in California in particular, because of Prop 13, because of the capital gains laws, who've lived in their homes for a very long time, and their homes are worth way more than what they paid for them back in the day. And unfortunately, the threshold for what constitutes a kind of exorbitant gain in the minds of the U.S. government was set 30 years ago, right? So it's like set based on prices back in the 90s when homes in Bakersfield did cost $100,000, right? If that goes through, especially now that people can take their property tax base with them if they move to a different home, those folks over 55 at least, those are mostly the ones way above these big thresholds. It's the long-term homeowners. If that goes through, we estimate in California, just in California, there's like 1.6 million homeowners that are above that threshold, just because by no fault of their own, they lived in their house, it went up, now they can't move without paying a huge tax bill. Not all those 1.6 million people are going to move, right, just because there's no capital gains, but some will. And even, you start throwing out just even small percentages and applying them to 1.6 million, starts to add up to real numbers, right? Like 10% is 160,000. That's like more than half the sales that we did this whole year just from one policy, right? So I think that could really, especially if they do, as bad as the shutdown is and all these kind of political things, which I'm not an expert in, I think it does create the incentive for both sides to deliver on some kind of a win to the American people so that they're looking good for the midterms next year. And our political folks who do study this stuff tell me it's more likely that this capital gains thing could happen over the next 12 months or so than it has been in a long time, because they're both feeling like they're not looking good and wanting to deliver on some kind of a material thing that will actually help people. And that one would be amazing for the housing market here in California. And then bottom line is that our forecast is positive. I don't mean to scare you off 2026. I think the dedicated, informed, expert realtors are going to have their best years ever next year. But I think you can't take it for granted. That's more the point of why I'm kind of poo-pooing what's otherwise a relatively positive forecast, is because I think there's going to be more transactions, but not so many that you can just rely on it happening through osmosis, right? You're going to have to be peeling off those high-income renters and getting them to buy, right? And then they can always take advantage of lower rates in the future, but you can never go back and pay the $100,000 price, right, that everybody else got back in the 90s. So that's a critical point to understand. And I think on the sell side too, you're going to just have to really manage expectations. I tell you about my ex last time when I got divorced. She like first thing she does goes on to Zillow, right? Like, oh my God, we're rich, right? And consumers are not in the weeds of this stuff, and then they're like not realizing the market shifted a lot. We're less competitive than we were a while ago, and like, you know, the house isn't worth what Zillow is telling you. When it's sitting on for 20, 30 days, the sellers are calling and blaming you, right? Like, you don't know how to market a property, you don't know what you're doing, right? And they're not like kind of in the weeds. So you need to be really communicating and managing expectations. Otherwise they go, you're a terrible agent. Like, are you guys on TikTok? There's all these like funny TikTok real estate things. And it's like this homeowners that are like, you know, my house isn't sold, it's been 50 days and blah, blah. She's like, it's not the price. We already know it's not the price. She's like, but we are going to get like new pictures. We just got a new agent, but it's like, it's on the MLS. It's not the pictures, dude. It's the price. Okay. But like, this is where they're at, right? Because they've drank the Kool-Aid on this estimate and now they're blaming you for it. And you need to make sure on the front end that they know that we have to price it strategically. I know you want a boat, right? But we got to like put the number where it should be and not just like kind of throw out a number and hope for the best and shoot the moon. We're not in that kind of environment. So positive forecast, but you're just going to have to keep that nose to the grindstone, keep that foot on the gas, because you've got a lot of misinformation that you're going to have to be undoing. It's like a communications game at this point, more so even than a tactical real estate thing. So that's the spiel. Let's look at some pictures, right? Well, point number one is why, you know, one of the reasons why transactions haven't bumped despite the strong economy is just like, it's been curveball after curveball after curveball this year. I stopped making this list at like 10 items because I was like, this is just going to be a giant like mash of text because there's just been so many different curveballs. But this is the type of stuff that means even 4% unemployment doesn't translate into 400,000 or 500,000 home sales, because people are scared about the future, right? And there's all these kind of wild cards that are giving people uncertainty. They're just kind of in a wait and see mode, and that's been the case now for about 2 years straight. I don't have to read these, you can read them. There's been a lot of stuff. The good news is we started the year about 7%, and we're down about 6-ish%. Actually, this morning it was like 6.3. That's good, that helps. But guess what? We were at like 6.3% like 3 years ago. So like, while you've been waiting around, listening to your brother-in-law who told you to just wait for the 4%, like prices have gone back up. Rates are finally back to where they were 3 years ago. The good news is going from 7 to 6 has helped though. So that will, you know, people are like, oh my gosh, my brother-in-law's forecast is finally coming true. No, this is what the Fed's been telling us they were going to do for 3 years, and they're just very closely sticking to the guidance that they're giving us. If you look at the broad macro data, I just pulled out a handful, but you could pick any ones you want. These are the, you know, two important ones from my standpoint. GDP, that's the overall size of the economy. Personal income, they're high, right? They've never been as high as they are right now. You've never seen an economy generate more income than ours did in the second quarter of 2025. So that's all very positive, right? Unemployment, even with the recent uptick in unemployment, and unfortunately this stuff only goes through August because we're in a government shutdown and the BLS is closed. But through August, and things haven't deteriorated that much, the Dow's still at 47,000 or whatever it was this morning. We're still at sub 5% unemployment nationwide, right? Even with the layoffs that we just heard about in California, we're at 5.5%. That's essentially full employment, right? So jobs, GDP, retail sales, pick one, right? Shout them out. They're all up there in terms of very high numbers. In California, we're still processing unemployment insurance claims, right? So the state EDD is not affected by the shutdown. So we are getting California unemployment insurance claims, and these run up through last weekend, I think, or that last week of October, probably. I think they're 2 weeks behind. You don't see a big surge there in unemployment, right? So even though Amazon and whatever other layoffs we've read about in the paper over the last couple of weeks, in aggregate, right, you haven't seen a huge increase in the number of people that are on government payroll, essentially, is the takeaway from these ones. In California, non-farm jobs-wise, these are two different surveys. With the exception of the Bay Area, we're flat, right? We're not adding a ton of new jobs, but we haven't seen a big contraction in employment either, right? So it's not that everybody's unemployed anymore. You're just seeing the businesses kind of pumping the brakes on new hiring, just meaning that we're not going to see that same kind of accelerated growth that we've enjoyed up to this point. I do think the Bay Area number is kind of a cautionary tale for us in just California and the U.S. economy as a whole, because I think they're on both sides of the AI thing, right? On the one hand, they're doing all the $5 million a year plus a $12 million signing bonus type of like AI engineer jobs. But those are far fewer in number than the amount of like office admin, marketing types that are just falling by the wayside as they throw more of those tasks at the computer, right? And so when you put it all together, in aggregate, the negatives outweigh the positives from at least an employment standpoint, right? And that's why, unlike the rest of California, the Bay Area, I think, is already on its downward slide for a jobs thing. They're suffering from both all of this macro uncertainty and policy stuff. And then they're also like, well, hey, we're early adopters of this stuff. Let's throw it at ChatGPT and see what happens, right? And that's how they're meeting the ongoing demand without having to ramp up those payrolls. And if that, becomes a broader thing, right, then we've all become the horse and buggy kind of the U.S. economy. Juxtapose all of those real hard macro numbers against this one. This is consumer sentiment from the Conference Board. We only have data through September thus far, and it has rebounded a little bit to 55. But 55 from 50, where we were I think in April, we were at 52, which outside of during the pandemic was the lowest level we had seen for consumer confidence going even before the 2008 financial crisis, all the way back to the 80s, basically. Think about that, right? Like, that's weird because we have full employment, GDP, income, all of this other stuff at all-time high levels, and people feel worse about the economy when they're called and asked in a survey than they did when the stock market had just been cut in half, right, after the financial crisis, when 15% or so of Californians were unemployed. That was back here. Consumer confidence was higher than it is right now, when everybody who wants a job is working, right? And this is why forecasting is kind of breaking down, right? Because it's really a tale of two economies kind of happening. This is what happens when you put the whole entire economy together into one pot, but increasingly it's the very high income that are driving all of the growth, and everybody else is just kind of treading water on the cost of homes and haircuts and food and gas and all of that stuff. The other thing I think that means we've got, to manage our expectations on how much rates are going to come down is that the Fed really cares about inflation. Like, they've been absolutely clear that in the absence of conclusive signs that inflation is gone, they're not going to do big dramatic rate increases. That's why we're 3 years into this. We've only got, I think, 5 rate cuts now, and they've all been small and very sparsely scattered. If you look at this is one of the main metrics on inflation. The blue stuff is the headline consumer price index, and I've converted it into an inflation percentage for you. They want this number to be at 2%, and it's still at 3%. More importantly, it's been trending back up after we'd kind of gotten the lid on it. We still import a lot of the stuff that we consume from the rest of the world. So when we, that's one of the byproducts of this trade war, is that it might stimulate manufacturing long term, but until we can source parts domestically for cars and all of this other stuff, we're starting to see that affect us on the inflation side of the ledger. Inflation's not 10% the way that it was a few years ago, but it just means that if you're banking on huge, dramatic Fed rate cuts, you're probably not looking at this chart, because the Fed is not going to move without clear improvements on consumer prices. The good news is rates are already normal by historic standards, or even a little bit better than what they average historically. But if your whole kind of reality is based on, rate cuts in the future, then you're missing that point, right? And you're just sitting on the sidelines while prices keep going up. These are the numbers for Bakersfield going back over time, and actually last year we already started down the road to recovery. Keep in mind the 25 numbers only through October, so there's still a few more months of transactions to add on to that one. But we still, already started to improve in total home sales last year in Bakersfield. But even with that growth, you can see like normal, forget like 21 when rates were at 3%, like even 2017 levels are still a long way off for transactions, right? So even as the market continues to improve, what you guys used to feel like was a normal market environment, like it's going to take several years of accelerated growth consecutive to get back to what we used to think was normal. So moving in the right direction, but just managing your expectations about how quickly that's going to happen and how much of like your own destiny is going to be up to you, right? And not just relying on that rising tide to do it for us. If you translate it into a percentage, I've already done that for you here. You can see that we were up 3% compared to the year before. And right now, we've kind of plateaued again and are down 1% for the first 10 months compared to that same time period of last year. What's really interesting, and we talked about this a little bit this morning over coffee, is like if you break the market up by price, you can see that same kind of tale of two economies that I talked about in the macro stuff playing itself out here in the local housing market. Because if you break down that 1% that we're down this year in terms of total transactions, it's because the entry level is down a lot and the kind of top end of the market is up a lot, but it's not big enough to cancel out the entry level. And that is essentially the tail of the tape of what you see here. Double-digit growth in 750 to a million in Bakersfield this year, right? Sales are strong at the upper end of the price spectrum here locally, but it's just not small enough. If you compare Bakersfield to the state as a whole, you can kind of see that the type of environment that we're in really matters. So this is comparing growth in transactions locally to the state as a whole. And what I would point out is kind of the two different types of environments that we are in. If you go back to 21, when it was an entry level kind of owner occupant jumping in to take advantage of 3% interest rate, kind of working class retail home buyers driven marketplace, Bakersfield outperformed, right? And actually, and when rates went up a lot, everybody suffered, right? So that's pretty consistent. But if you go back to last year, I would argue it was more a stock market driven housing market last year than it was an interest rate one, right? Like rates didn't do a lot in 2024. People were just waiting for Fed rate cuts all year, and the mortgage rate just fluctuated throughout the year, more or less. But the stock market went up to all-time high levels, and you saw places like the Bay Area and LA start to come back. And so when it's very stock market driven, when it's very affluent, high income people doing most of the transacting, then that's not our sweet spot, right, in Bakersfield. I think I brought this. Oh, yeah. What's really interesting is, like, if you look at Bakersfield's top end of the market compared to the state as a whole, we're actually even outperforming, right? But the problem is that our top end of the market just forms a much smaller share of the overall housing market here in Bakersfield because we don't have a Beverly Hills size thing or these big, huge, high home price areas that form a bigger share of the statewide housing market than they do of the local market, right? So I'm not going to belabor this one. These are sorted from lowest price. So I went into your MLS and you guys have areas. And I worked with Derek back in the day. We grouped the areas into these 5 kind of sub parts of Bakersfield, and then I sorted them from lowest price, lowest median price to highest median price. So the left is always, I think Oildale is the most affordable, and then Northwest Bakersfield is the most expensive, right? So that's kind of how you can read this chart. What's encouraging is if you look at this year, it's actually kind of the middle of the market, but really Northwest Bakersfield, again, backing up this tale of two economies story of like parts of every region that is doing the best is the one where the people with money are buying, right? And people with money are still buying houses, right? And it's people without money still want to buy houses, but there's a gap in terms of making that actually come to fruition. This is the one that I wanted to show you and why it explains how we're underperforming the state as a whole, even though the top end of our market is doing better than the top end of the statewide market, is because it takes you, you've already gone through 95% of the transactions before you get to the share of the market that's booming, right? Like 750 on up in Bakersfield was growing by way more than it is in the rest of the state, but that's only 5% of our homes, right? So in the rest of the state as a whole, right, like just $1 million and up is, 35+% because our median price is 900 and something thousand, right? So this is why I think if you kind of extrapolate that forward and as rates come down, that should benefit us more, right? Because you're going to see that entry level buyer start to come back, that kind of retail home buyer start to come back a little bit. But I think because affordability's gotten so bad, and you can kind of see that here, right? 405,000 was the number for October. Actually, this is September. I didn't bring the October number, right? But you didn't see a huge give back. Even when rates doubled, almost essentially overnight statistically, prices in Bakersfield like paused and took a little bit of a breather for a minute and then resumed that upward trend. And that's like the Econ 101 stuff of us not building enough. I thought it's funny, all these buyers that are like waiting for lower rates or waiting for the foreclosure, like even when rates doubled, show me when prices became better for you on this chart. They just kept growing the whole time. The question was by how much, right? It's great that they're growing by 2 or 3% now, right? For you as a buyer, because your income might have a chance at growing by 2 or 3% a year, but still growing. The homes are still becoming more expensive no matter how you slice it. If you have those like high income, gainfully employed renters that are just sitting on the sidelines waiting for that foreclosure, that 4% interest rate, I would print this one off and show and say, like, point to me on this chart a point in time when it made sense for you to wait to buy a house in Kern County, right? Like, unless you think like you're a sage and you can predict those, right? Then God bless, go ahead, do it. And but outside of that, like the further right you go, the higher the line was. I don't know how else to say it. It's just the longer you wait, the more expensive it becomes. We don't build enough. That's why. The good news is if you look at the pending numbers, and this is Bakersfield specific, I don't know if you guys go on our website, but we have a weekly market data report that we put out for the state. I went in and filtered that to just Bakersfield so you could see the weekly stuff. But I brought it because I just wanted you to see that this little decline in rates, what I think is a little decline in rates, has caused pending to go back up. We're already deep into the winter pretty much, more or less. Like sales should be trending down, not popping back up. This is not the buying season. If you convert that into a year-to-year growth rate, like the pendings in September were up 13% locally, and then they were up another couple of percent in October. We haven't put out the October number yet, so don't get me in trouble at work. Keep this between us and the video recording. But the flip side of this rebound in demand, and one of the main reasons why I've been saying like stop waiting for rates this whole time, is because we have a fundamental supply and demand problem. We haven't built enough homes for 35, 40 years, meaning that as soon as demand turns around, competitiveness is going to turn right back around and the inventory is going to disappear again. Active listings are already on the downtrend here in Bakersfield, and you can see that, and they peaked at levels that weren't actually particularly impressive to begin with. We only started doing weekly data with the pandemic, so you can only see this chart back to the spring of 2020, but if I zoom this out by 10 years, you would see that the current level of actives is still a very depressed level. It's just not the hyper depressed levels that we were at when rates were 3%. And declining is the more important part, right? So as demand turns around, it comes right out of our available inventory. Why is that? It's because we've never been replenishing the MLS with more and more and more new homes. The reason why the active listing number was going up was because home sales stopped and homes were sitting. So when you look at actives, that's just how many are active right now. When I look today, it's a different number than when I look later today, than when I look tomorrow. That's a moving number, right? Stuff's getting listed, stuff's closing, stuff's going pending. That number's moving around all the time. The reason why the actives were going up was because every week there was more unsold stuff that was carrying forward. This is the replenishment number. This is how many new listings got put onto the Bakersfield MLS week by week. That number never went up, right? That number's been very depressed now for 5 years in a row. The actives were up because homes were sitting longer. Right? And so what does that mean? Why does that matter? Because as the pendings go up, as the demand turns around, right, it's not coming out of these replenished, like we're not putting new cans of corn on the shelf at the supermarket and they're coming out of the, right? This was just stuff that was just already sitting there. The buyers have come back and bought it. There's nothing in the warehouse, right? There's no new supply. There's no deliveries. There's no trucks queued up to put these homes onto the market, you get me? And so that's why even a little increase in pendings is coming right off that top line active inventory number. And what does that mean is that like actually days on market is like stopped its upward trend. It had been becoming less competitive for you as a buyer. There was buyers that were scared off. There was more active listings out there. More sellers were reducing. Less stuff was closing above list price. You might have waited too long, right? Because again, it all comes back to the econ. Headlines are scary and they cause people to do all this crazy stuff, but eventually the underlying economic fundamentals reassert themselves, and we're a state and a region, unfortunately, with just too many people and not enough homes. Simple as that. Prices are a function of supply and demand. What could make the economy and market do way worse? Stock market's inflated. The stock market right now is worth about 40 times earnings if you measure it by the S&P 500. This chart goes back to 1871, so I can say pretty definitively that you don't see stock markets really more overheated than they are right now. The one time that they've gotten higher than this was during the dot-com bubble, and immediately after they got to that level, they went back to normal, right? The other time that they've ever been, like even in the territory or the neighborhood, remember this? 1929, that's Black Friday, Great Depression. So again, this isn't a forecast. If I could forecast when that was going to correct itself, I would have already bought the puts and I'd be on a beach in Hawaii counting the stacks right now. But it is imbalanced, right? And you can see the imbalance. This isn't a hindsight kind of thing. The stock market is worth way more than what these companies are making. That is not sustainable. So it's going to correct itself at some point in one of two ways, right? Either the earnings are going to catch up and they're going to start actually raking in money and selling stuff, or the price has to come down of those stocks, right? One of the two is going to have to happen. That has, if you think about kind of what we talked about and how psychologically driven this environment that we're in, all-time high numbers, all-time lows for consumer sentiment, right? What does that do if this corrects itself? It affects the sentiment number, right? Which will then bleed over into the real macro economy, because then I'll really tighten belts, right? Then I'm really not buying that car, that house. I'm doubling down on my brother-in-law's newsletter. I'm going to ask him to start writing 2 a week, all of that kind of stuff, right? The other thing I'm worried about, actually, let me back up. The other thing I should say is that this is also not just an indirect effect in like the psychology of the U.S. population base. This is what's been fueling a lot of the luxury home sales that we talked about up to this point, right? Is that people feel rich in their pension and their 401k, what have you. So if that goes away, it's not just a psychological thing. All these rich people aren't going to come out and buy giant properties out here from LA and do all that kind of stuff. You'll see that start to die down. One of the things I think that could trigger a stock market correction is commercial, and the office market in particular is doing bad, but this is headline just total all types commercial mortgage delinquencies. And again, think about these numbers through the lens of us still being at full employment, still being at all-time highs for the stock market. Even under those kind of conditions, we've got really elevated levels of commercial mortgage delinquencies. Now in California, in the West region, we're doing a little bit better, but unfortunately there's no such thing as a 30-year fixed rate office loan, right? And so a lot of these offices have had to go out and re-up their debt at much higher interest rates than they had back in 2021, and they have huge vacancy rates. The office vacancy in LA, San Francisco is like 35%. So not only do they have these huge increased carrying costs of these buildings, but they also have no people to put inside of them, remote work, companies, all of that kind of stuff. And so again, even with all-time high macro stuff, the office delinquency rate for mortgages is super high, right? Higher than pretty much any time in the last 25 years. Banks are on the hook for this debt. So if these offices go belly up, banks are hurting, stock market, luxury home sales, right? That whole kind of vicious cycle that we talked about up to this point. We're also seeing it to a lesser extent on the multifamily side. HOAs are grappling with just inflation, right? Like all the gardening and just services that they provide, the insurance costs, and then all these other like regulations on balconies and different crazy stuff that's happening means that even at, unlike office, most multifamilies fully occupied, but even with full occupancy, the cost is outpacing their ability to do assessments and stuff like that, right? And you're starting to see more and more multifamily go delinquent as well. The other thing I'm worried about is consumers. We are just a consumer-reliant economy. 70% of our economy is consumers, and they've been driving us by using their credit card for like the last 3 years in a row. Credit card debt is up a ton, even just since the start of the pandemic. I didn't show the car loans here, but if you add credit card and car loans, it's like $1 trillion of new debt in the last like 5 years. And that debt, as you can see on the lines, is becoming increasingly delinquent. So just that's the main fuel for the U.S. economy, and it's running out of gas, right? Actually, and the growth that we've experienced, I'm going way too long, but the growth that we've had has largely come from people making over $100,000 a year. They're still out spending. If you go to Costco, it seems like the economy's firing on all cylinders, right? But then everybody else is suffering with the cost. We also have huge affordability things, meaning that even if every kind of positive economic scenario happens, it doesn't mean a lot of home sales. We've had a lot of prosperity. Home prices and incomes are up a lot in aggregate, right? If you go back 40, 50 years, incomes have tripled or more. But if you look at the median, that's putting everybody together in one big pot and adding up all the incomes. But the wage for just the typical worker has gone up nowhere near that amount, which is why even as the economy is at all-time highs, we don't all share in that equally unless you're in one of those growth industries, right? If I do software and computers and all these things that are going through the roof, it's been great. If I am a housekeeper at a hotel, it's been less great. I've seen everything go up that I buy. My wage has been about the same, right? So at least when you adjust for inflation. One of the main reasons why affordability, though, has gotten so far away from us is just because we don't build enough. I think I've showed you guys this every year for the last 5 years, but we build a fraction of the housing that we did in the 70s, but we're twice the size. So you don't have to be a mathematician to figure out why home prices in California are $900,000. You don't create a ton of high-income jobs and slash the amount of new construction that you do and have homes become cheaper, right? Did I do the Taylor Swift thing last year? It's like we turned the housing market into the Taylor Swift concert. You've got, a stadium that seats 10,000. You got 50,000 screaming teenage girls out front. And that's how you get those people walking up and down the sidewalk selling tickets at 5 and 6 times what's printed on the face of that ticket, right? That's basically the analogy of California's housing market here. And it's just very simple arithmetic. If you look at our overall trend over the last couple of years, it seems positive. Like, oh, that's upward sloping, right? That looks good. We're building more. It's only because of this little green slice down here, or blue. I don't know. I'm colorblind. Those are ADUs. ADUs are working. People love ADUs. If you have money, if you have equity, if you got space, people are building ADUs. We can't all live in an ADU. It's an accessory dwelling unit, right? So you need the main unit first, right? Like we can't just ADU our way out of this thing. And when you strip the ADUs out and look at single and multifamily, not super encouraging, right? It's encouraging for me because I already own a home. That means that my house is going to keep accumulating home equity. I'm going to become richer and richer, right? But for my kids, for our economy, for everybody that wants to buy a house that can't, not as positive, right? And again, that's how you get, this chart is like tells you everything you need to know about California's housing market. How many units did we build? How many people live here? And what is our median price, right? You look at some of these states that are a fraction of the size. I love this one, Tennessee. That's one of the ones I think that you said you had some clients that moved to Tennessee. Tennessee has 7 million people. It takes 5 Tennessees to make one California, population-wise. But Tennessee's building half as much homes over the last 5 years as we did, right? And that's why people in Tennessee can afford to own their own homes. Simple as that. Same thing. Look at Florida, right? Florida's half the size of us. They built twice as much as us. Why are homes in Florida less than $500,000? They have enough homes for the people that live there. Okay? Bakersfield, we might be tempted to self-congratulate because we do have an upward trend, and it's not just ADU, right? A lot of single family here, and the number is upward sloping. But unfortunately, that's still not enough because we're not only having to accommodate our own population base. Well, number one, these are small numbers anyway. It's like 1,900 was a big year. 3,000, I don't know what this was. This must have been some massive development in 2017. But they're relatively small numbers still, and the proof is in the pudding of that $405,000 median home price and the lack of housing affordability here in Bakersfield. Prices in California are directly the result of this lack of new construction. Prices are up 8 times from where they were in the 1980s, prices are up 8 times. Incomes are up 4 times, right? We've created a ton of prosperity. Incomes are 4 times what they were 20, 30 years. I guess the 80s is 40 years ago now. Dang it. Nevertheless, though, incomes are up a lot, but just home prices are up even more, and it's because, again, that lack of building. Even in Bakersfield, which is one of our most affordable areas in the entire state, our home price is a lot lower, but our incomes are also lower. And so when you look at affordability from the standpoint of what can people in Bakersfield afford, we're right on top of that statewide average for first-time buyers, meaning that, almost 70% of people who live in Kern County cannot afford the median priced home. So even as the economy is doing well, again, it doesn't generate tons of growth in home sales because it's only the upper end of the economic spectrum here that can take advantage of that growing market and all of that stuff, right? Consumers could continue to spend, but I think, it's that really this kind of affordability challenge is what underlies why even at full employment, people are really depressed, right? I don't care if everyone else has a job. If I can't afford to live here and I can, I'm having to choose between lights and groceries and stuff like that, or right, all these different trade-offs. I think that underlies this kind of pessimism that exists out there. I think that's also why everyone's moving to Tennessee and Florida and all these other states, right? I can sell my house here. That money goes a lot farther in another state. The political environment's kind of a nightmare, and all these other shenanigans on rent control and different stuff that motivates people to leave. But I think the biggest overarching factor is I could stomach a lot of that stuff if it wasn't so expensive, right? I would hold my nose, and high income people do that, right? They're not staying here because of the preferential tax treatment, right? But they'll stay here because they like it anyway, and they can afford to pay these excessive taxes and all of that stuff. I'm not going to Texas no matter what. I don't care. But if, I had 3 kids and I made 60 G's a year and I was living in an apartment, then that would be, Scottsdale starts to look pretty sweet. And you're seeing that we're a net exporter of people now from California. And the people that we're losing are just the critical people that we need for our economy. The highest concentrations of out-migrants aren't the high-income people in green, although we have started to see some of our scientists leave a little bit, but this is a very nascent trend. The bigger issue is all these middle-class people that we need to build our economy on. Construction workers, office workers, teachers, production workers, truck drivers, trades, right? How do you build homes when everybody from a trade moves to Texas? So throw that out there as food for thought. This is that kind of K-shaped thing where high-income people are growing and everybody else isn't, which means that the luxury market will probably continue to do well. But I'm less pessimistic about the entry level than this is from Realtor.com. I just stole this because I thought it was a cool graphic. But I think based on those pending numbers, we can be a little bit more optimistic about the entry level. Those buyers have been waiting for rates, and even little declines in rates have sent them back into the market, at least a little bit. So I do think the top end is going to outperform, but I think there is some hope. Rich people are going to keep buying real estate. I think for all those scared off first-time entry-level people, ask yourself, what are the people with lots of money doing? They're buying more real estate. They're buying with cash. They're buying vacation homes. They're buying, on top of that, homes to hold and rent for the long term. They're connecting the dots on that long-term supply and demand. Home prices can only ever go one way in California outside of big economic catastrophes because we don't build enough. And so people with money are even more attracted to real estate. I think there's a chance that the stock market could, instead of correcting itself, it hasn't done that to this point, it could go to 50,000, 60,000, and we just keep our, banking on AI being this kind of unicorn thing that, I don't know. I'm skeptical, but it could. And if that happens, then that's a lot of luxury home sales too. Paradoxically, if the stock market tanks, that might also be good for real estate because you're going to see everybody get scared and put their money into something like a hard asset. But I think the big one is the capital gains thing. I'm not going to belabor this, but people do have a lot more purchasing power because of that increase in rates. The bigger point that I wanted to make is that if you're waiting for the foreclosure, you are not very good at math or something. Because if you go back to when prices were declining rapidly, like that brother-in-law who says the the foreclosures are right around the corner, when prices were coming down substantially back in the 2008 financial crisis, it's because everybody was dumping their house. They were foreclosing, they were short selling, they were running away, they were in a 5-1 option arm, and their mortgage just blew up on them, right? All of that stuff. What it takes to generate price declines is an imbalance in supply and demand the wrong way. Too much supply, not enough demand, right? So we were at 17 plus months of supply. That's what it takes to generate big price declines. You need to be up in the double digits with homes that sellers cannot give away because nobody wants them, right? We're at 3.6 months of supply right now. So like for those, even with that increase in the actives and people are like, oh, they're coming, the price declines are coming. Anybody who's been in the business more than 5 years can tell you like 3.6 months of supply is not a good number. That's terrible. Why are we not going to get up to 16 months of supply this time around, even if the stock market tanks and all of that? Is because of this number right here. Over 60%, which is 3 out of 5 California homeowners, and these are just the homeowners with a mortgage. Actually, a third of California homeowners own their homes outright at this point in time. These are just the 2/3 that still have a mortgage. They're in a sub 4% mortgage. So moving means paying a lot more money, even if you rent something, even if you go into something way cheaper, right? When I got divorced, I sold my house with a 3% mortgage, and it was on acreage, and I had all this nice stuff. And I'm in a small condo now at a 6% interest rate, and I pay the same mortgage payment. Still best money ever spent, not to say that, but for anybody else who's not got that financial gun to their head, they're going to hang on to that 4% mortgage at all costs, meaning that even if bad stuff transpires economically, we're not going to see that flood of inventory the way that we saw last time, and the way that's needed as a prerequisite to see those prices come down dramatically. So I do think that even as the lock-in effect loosens, just be prepared. People are staying in their homes longer and longer. That's the other reason why I think there's a ceiling. It's going to get better, but for a lot of reasons, it's not going to be getting better so rapidly that it's just going to happen to you automatically. Make your own destiny, right? Be that communicator. You can see the forecast is positive. You wouldn't think it if you just listen to the last hour, but it is positive. The GDP number is going to go up. We're going to create more jobs, barring some unforeseen crazy thing that happens. Sales are going to go up by a couple of percent too. So will prices, but it's just they're all modest increases, and we can't bank on anything but the kind of status quo of lots of uncertainty, having to talk people away from bad information substantially. And I think that really is the name of the game. And just keep your nose on the, to the grindstone, because this is what the forecast looks like visually. This one is not my forecast, but I just extrapolated what would happen if we just had back to back to back to back to back double-digit growth years for transactions. We would just only barely have gotten back to what we used to consider a normal level by 2030. Right? So again, there's a chance if the capital gains thing goes through, we could see a flood of sales and we could get back there a lot quicker, but barring some kind of real solid shot in the arm externally, it's going to be kind of slow going, and with a lot of undoing of this brother-in-law effect that happens out there. So I think you got to just be a communicator, do all of these things to manage expectations and make sure both sides of the transaction are locked in on what the reality is and not what the headline told them it should be or something like that. They need you more than ever. I have gone to 35 RPA training classes myself as an economist, just because a lot of times I'll do this with Gov. You know what I mean? So you won't find a consumer out there who knows a real estate transaction better than me, and I would have never been able to do it by myself. They need you more than ever, but that just means that they need you more than ever. You got to step up. You can't just be like, oh, look, find your own house on Zillow and then I'll help you fill out, right? Like they need you because these are complicated transactions. But I think if you embrace that and you level up your game and you lock arms with them, then I think even with all these shenanigans, sky's the limit. Thanks. Do you want me to do questions or? Yeah. You could have interrupted me the whole time anyway.
Hey, Jordan.
Hello.
Usually when we think of first-time home buyers, we think young people. But this morning on the news, they said that the median age for first-time home buyer is now 40. Of course, that's nationwide.
Yeah.
What do you think in California?
Exactly, young people.
Right on.
Yeah, that's a function of affordability, right? The older you get, generally, the more money you have. So that cutoff for when you make that move. I will say, though, that part of it is cultural. Although I think part of the cultural, I'm going to take that back. I don't think it's cultural. I think the cultural stuff is kind of symptomatic of the economics. Partly. I could get in trouble here. Well, people are getting married later, if at all. They're having babies later, if at all. They're having fewer babies. More women are getting higher. Actually, most of the college graduates are women now. The higher your education goes, generally, the less amount of kids that you have. So, like, just all these things are being delayed. But I do think there's kind of there's a weird demographic thing happening out there. This professor I know from USC calls it like he called it a mismatch in the dating market, basically, because like, anyways, it's prolonging all of the life events from happening. So I think that is going to be the norm, but I think it's also affordability driven. The moral of the story, if you want to look it up, his name's Richard Green. It's great, but he basically said that women won't marry somebody lower economic status than them, and because all of the college graduates are women, they're just mathematically isn't anybody desirable to them, and so a lot of guys living at their mom's house still. Thank you.